Well, we are seeing better flows into the US equity market actually just in the last 2 months. So I think what's happened is certainly after Q4, when we had this sort of, I think it was the worst December in 30 years, January the best January in 30 years, we're actually seeing much more inflow coming in from retail investors. So I think there's maybe some actually some quite smart buying, actually buying low. Generally, retail investors tend to buy high and sell low. That's what the history shows. But actually, we're seeing in the last 2 months quite the opposite behavior. That actually retail investors have come into the market.
Well, let me ask the opposite side of that story. For every buyer, there is a seller. Are those people who are selling those shares to these companies who are buying back being smart about disposing of those holdings at this point?
Well, in terms of, I guess, taking a long-term view on the equity market, maybe there are some sellers out there. Maybe they feel that the tax cuts are behind us, corporate earnings have peaked. But actually, I think purely on a valuation basis, it was a lot cheaper at the end of January than we were, say, at the end of November. So I think that there is definitely a valuation case there, which the retail buyers seem to pick up on.
Good morning, Julian. How much of the rally is also down, as well as the actual factual buying of retail investors and buybacks, how much of it is also down to the fact that people think the Fed has paused and they know the Fed has paused, but think the Fed has finished on being hawkish as well, which I think it may prove right, but it may also be premature.
Well, I think firstly there is no inflation. I think Jeff mentioned that. There is absolutely no inflation. Core inflation in the US is 1.9%, and I think the Fed has basically woken up to that fact. So I think it's very welcome. And if you look at the equity risk premium, the fact is that equity returns tend to be a function of how low interest rates are. It's a kind of the net present value of those earnings just gets boosted. And if we have the Fed on pause, which they should be, I think they're right to be, then I think it's rational that the US equity market should make progress from here. Earnings, okay, the rate of growth is not as strong, but it's still positive.
Can I get into whether retail investors are right to be investing at this point? And if you think where some of the money's been going, it's gone into communication services, which houses a lot of the FANG stocks these days. So the likes of Facebook and Netflix, Alphabet. And one of the concerns is that there's more regulation coming, that we may have seen the best of it, at least for a while, because of the deep investments required to mitigate some of those regulatory issues, more competition coming into the mix. What do you make of that overall basket of communication services?
Yeah, I mean, there's definitely, I guess, what we'd call a tobacco moment facing the communication and internet sector, more regulation coming in, as you say. But on the other hand, if we're in a low growth environment, you're going to need secular growth. And I think investors are looking for secular growth, something that can transcend the fact that the US economy is only predicted to grow at 2.5% in 2019.
But some of these are consumption stocks. I mean, many people saw them separately as technology stocks, but
it's consumption that didn't exist before, I guess. It's Netflix. People didn't consume that. Well, they did 10 years ago. I guess they were renting the DVDs, but that online streaming, for example, that didn't exist. And it's not to go into the stock specifics of Netflix, but I think a lot of this consumption it's a secular change. It's things that simply did not exist previously. So it's a new revenue stream. So I think investors are right to tap into that.
Hi, I'm Joanna Bersecci, and thank you for watching. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to our channel for more from CNBC International. Thank you for watching.